Okay, so real quick. Monday, June 2nd, 2026, the S&P 500 closes at 7,609, all-time high. The Dow crosses 51,000. The Nasdaq crosses 27,000. Every single major index, same day, simultaneously hitting numbers they have never hit before in the entire history of human civilization. Financial media loses its mind. Analysts are basically doing cartwheels. People are checking their 401k like it is a scratch card, and they just won. Vibes? Immaculate. And then, Friday, same week, 3 days later, the Nasdaq drops 4.2% in a single session. Semiconductor stocks lose $1 trillion in market value in one day. Nvidia alone, just Nvidia, wipes out $300 billion. Micron falls 13%. Intel falls 11%, AMD falls 12.6% day. So let me get this straight. Monday, all-time high. Friday, $1 trillion wipeout. Same market, same week. Same 401k you were smiling at on Monday is now giving you anxiety on Friday. How, why? What is actually happening? And most importantly, should you be panicking right now? The answer is no, but not for the reasons financial media is giving you. Stick around because by the end of this video, you are going to understand exactly what is going on. And you are going to understand it better than most people on Wall Street want you to. Let us get into it. How did we even get to 7,600? Okay, so first, some context. Because 7,600 sounds like a made-up number from a video game, but it is very much real, and you need to understand how we got here. January 2026. S&P 500 is sitting around 6,000, already up 25% in 2024, already up 16% in 2025. Back-to-back-to-back years of absolutely unhinged returns. The market is basically that one friend who keeps getting promotions, and you are happy for them, but also like, really, again? And then instead of taking a breather, the market just keeps going. 9 consecutive weeks of gains. From the beginning of April all the way through May, 9 weeks straight, no losses, just up. If it had gone one more week, it would have been the longest winning streak since 1985, when Ronald Reagan was president, when Top Gun was a new movie, 41 years ago. And what is fueling all of this? AI. Same answer it has been for 2 years, but now at a completely different level of unhinged. Nvidia drops a new chip for personal computers. Stock jumps 6% in one day. Nvidia's CEO Jensen Huang, who at this point has the energy of someone who knows exactly what he is doing, publicly says he likes a company called Marvell Technology. Marvell's stock surges 33% the next session. One man, one comment, 33%. Meanwhile, Hewlett-Packard Enterprise beats earnings. Goldman Sachs, the most powerful bank on earth, raises its S&P 500 year-end target from 7,600 all the way to 8,000. Goldman Sachs told its clients the market is going to 8,000 by December. And when Goldman talks, the market listens like it is a group chat notification. And here is the part that actually justifies all of this, at least a little. The earnings. Q1 2026 corporate profit growth came in at 28.6%. Not 10, not 15, 28.6%. More than double what analysts predicted. The highest earnings growth rate since Q4 2021. Goldman's analysts now expect earnings per share of $300 for the full year 2026. That is 24% annual growth. And AI infrastructure companies are expected to account for roughly half of all earnings growth this year. So the gains are not completely made up. Real companies, real profits, real AI money. 9 weeks of gains, 24 record highs, market at 7,600. And then Friday, the villain origin story. Friday, June 5th, 2026, the U.S. Labor Department drops the May jobs report. And the number? 172,000 jobs added, roughly double what economists expected. Unemployment stays low, wages stay firm. Now, if you are a normal human being, your reaction to this is great. More jobs is good, right? People have income. They spend money. Companies make more revenue. Everything is fine. And that is exactly what makes the next part so deeply unhinged. The market immediately collapsed. Bond yields jumped. The 10-year Treasury yield shot above 4.5%. The 30-year yield topped 5%. And then the tech stocks, oh boy. Nvidia down 6.2%. Broadcom down 7.9%. Micron down 13.3%. Intel down 11%. AMD down 12.6%. The Philadelphia Semiconductor Index, which tracks all the chip stocks, had its worst single day since March 2020. Since COVID. Since the world literally shut down. The S&P 500 fell 2.6% in one Friday afternoon. The 9-week winning streak. Snapped, gone, done, one day. Bitcoin down 5%, gold down 3.5%. Everything sold at the same time. And CNN's Fear and Greed Index, which had been sitting in greed since April, flipped to fear in a single afternoon. So what happened? Why did good news destroy the market? Here is the thing that Wall Street does not explain clearly because it makes the whole system sound kind of insane, which it kind of is. When the economy is running hot, lots of jobs, lots of wages, lots of spending, inflation tends to rise. And when inflation rises, the Federal Reserve has to respond. The Fed responds by keeping interest rates high or even raising them further. The entire 9-week rally was built, partly, on the assumption that the Fed was done hiking and was about to start cutting rates. That assumption just got absolutely destroyed by 172,000 jobs. And here is why high rates specifically murder tech stocks. Technology companies like Nvidia and AMD are valued on their future earnings, profits they are expected to make years from now. When interest rates are high, those future profits are worth less in today's money. It is like someone saying they will pay you back in 10 years. The higher inflation and interest rates are, the less that future money is actually worth today. So the same math that makes tech stocks explode when rates fall makes them implode when rates rise. Not because the companies are doing badly, just because the math of valuation changes. Good economic news, higher rate fear, math goes bad, tech stocks crater, $1 trillion gone, Friday ruined. Same week as the all-time high. This is the market we live in now. Welcome. The 3 things nobody is actually saying, all right. Here is where we get into the stuff financial media skips because it requires admitting 3 uncomfortable things at the same time, and cable news cannot handle nuance. Uncomfortable truth 1, the market is priced like nothing can go wrong. When the S&P 500 was at 7,609, the forward price to earnings ratio, basically how much you are paying for every dollar of expected future profit, was sitting at 23 times. The historical average? 18 times. 23 versus 18 does not sound that dramatic until you do the math. At 23 times, the market is priced for a future where earnings keep growing fast, rates stay manageable, AI keeps delivering, geopolitics stays calm, and nothing unexpected happens. The market is priced for a perfect world. We do not live in a perfect world. We live in a world where a jobs report can wipe out $1 trillion on a Friday afternoon. And quietly, in the same report where Goldman Sachs raised their target to 8,000, their own analysts noted that at current valuation levels, investors should expect, quote, lower forward returns. Goldman's most bullish analyst is telling you the easy money is already gone, in the same breath as the 8,000 prediction. That is worth reading twice. Oh, and the Magnificent Seven, Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, Tesla, those 7 companies make up over 33% of the entire S&P 500. Your index fund, the boring passive thing you were told is diversified, is 1/3 a concentrated bet on AI tech. When Nvidia has a bad Friday, your whole portfolio feels it. That is not diversification. That is an illusion of diversification. Uncomfortable truth 2. We now live in a world where good news is bad news. Read that sentence again. A strong jobs report, 172,000 Americans got jobs, crashed the stock market. We have built a financial system so dependent on cheap money and low rates that actual economic health has become a threat to portfolio values. A healthy economy raises rate expectations, which crashes tech stocks, which crashes your 401k. Congratulations to everyone who got a job in May. Your employment data just wiped $1 trillion from the market. If the Fed has to choose between fighting inflation and protecting stock prices, and it might have to, it will choose inflation. Every time. That is literally its legal job description, not the S&P 500. Inflation. Uncomfortable truth 3. The market always recovered. You might not. Here is the stat that never makes the headline. The S&P 500 has recovered to new all-time highs after every single bear market in its history. 1929, 1987, 2008, 2020, every time. The index always came back, but the investors who panicked and sold at the bottom, the ones who could not handle watching their portfolio drop 30 or 40%, the ones who needed the money, they did not recover with the index. The index went up, their account stayed down. Studies consistently show the average retail investor underperforms the index by 3 to 4% every year, not because they picked bad stocks, because they bought near highs after reading headlines like S&P 500 hits 7,600 all-time high and sold near lows after reading headlines like $1 trillion wipeout in chip stocks. The market's volatility is not the problem. The investor's reaction to that volatility is the problem. The market does not destroy wealth. Panic destroys wealth. The market just provides the occasion. Where does it go from here? Okay, so the real question. Where does the market go from 7,600? Honest answer, 3 paths. All equally possible right now. Pick your fighter. Path 1, Goldman is right and we hit 8,000. The Fed threads the needle. Inflation cools without a recession. AI earnings keep delivering. Goldman's $340 EPS estimate proves accurate. Alphabet is deploying $80 billion into data centers. Microsoft, Amazon, Meta are doing the same. That capital expenditure has to show up in revenue somewhere. If it does, 8,000 by December is not crazy. It is just math. Path 2, the Fed has to hike and the AI valuation gets cooked. Jobs stay hot, inflation stays sticky. The Fed hikes or holds longer than the market expects. At higher rates, a 23 times forward PSS market becomes a 17 or 18 times forward Fiat market very quickly. That compression alone, No recession, no bankruptcies, just valuation math resetting to historical norms. Represents a 20 to 25% market drop. No drama required, just arithmetic. Path 3, the choppy sideways nightmare that actually kills most portfolios. The market does not crash 40%. It does not rip to 8,000 cleanly either. It goes up 7% one month, down 4% the next. Record high Monday, $1 trillion Friday, repeat for 12 months. This path is the most dangerous one because it does not feel dangerous. It feels manageable. But in a choppy sideways market, most ordinary investors slowly destroy their own returns by making 100 small emotional decisions. Selling the dips, buying the rips, reacting to every jobs report and Fed statement, until their portfolio has significantly underperformed, just doing absolutely nothing. The market goes sideways, the investor goes down. Death by 1,000 small panics. That is not a prediction. That is a warning based on how retail investors historically behave in exactly this kind of environment. What to actually do? Okay, real talk. Nothing into this video is financial advice. I am a stickman on the internet. Please do your own research. But here is how I think about this. 1. All-time high headlines should not change your behavior. Historically, buying the S&P 500 at an all-time high produces positive returns over the following 12 months more than 70% of the time. The headline feels terrifying. The data disagrees. Recency bias is the enemy. 2. Know what your index fund actually holds. If you own a standard S&P 500 index fund right now, 33% of your money is in 7 technology companies. You are not diversified in the traditional sense. You are 1/3 long AI. That is fine if you know it. It is dangerous if you think you are in a safe, boring, diversified fund when you are actually riding a concentrated AI trade. 3. The jobs report taught us something this week. Good economic data can now crash markets. That means we are in a data-sensitive environment where every report is a potential volatility event. In that environment, the investor who does nothing consistently beats the investor who reacts to everything. Counterintuitive. True. 4. If you are young, like actually young 20s and 30s, the 7,600 number is almost irrelevant to your financial outcome. The S&P 500 was at 666 in March 2009. It is at 7,600 in June 2026. The people who held through the crashes in between are fine. The people who sold at 666 and waited for clarity are not. Time in the market, not timing the market. Most boring advice ever. Most consistently correct advice ever. So here is where we land on this whole thing. The S&P 500 at 7,600 is real. The earnings growth driving it is real. The AI money is real. Goldman calling for 8,000 is not insane. But the $1 trillion wipeout in the same week is also real. The valuation problem is real. The rate hike risk is real. And the choppy emotional market that quietly destroys ordinary investor returns one panic decision at a time. That is the most real thing in this entire video. We just watched the perfect demonstration of what 2026 looks like. In 1 week, all-time high Monday, fear index Friday. The investors who understand that pattern, who have seen this movie before and know how it ends for people who react versus people who hold, those investors will look at their December statement and be fine. The investors who are currently Googling, should I sell everything? Those are the people funding everyone else's returns. Drop a comment. Are you buying this dip, holding steady, or genuinely moving to cash? No judgment. I actually want to know. Hit subscribe and turn on notifications, because this market is going to keep doing exactly this. And when it does, you want to already understand what is happening before the headlines decide how you should feel about it. See you in the next one.